Hello everyone, welcome to the webinar. Excited to see everyone at this latest in our monthly webinar series. We're just going to give it another minute or so and let everyone join the webinar, and then we'll be able to kick off. Before we start, just a couple of points to make. Don't forget that throughout the session, we're very keen for it to be interactive. So please ask questions in the questions tab of your GoToWebinar controller. For the session, we'll have cameras on for our introduction and the questions, but we'll turn them off as we get into the bulk of the program. But it's 2 minutes past the hour, so we might start. And as I said, thanks very much for coming along. My name's Stephen Dooley. I'm the currency strategist, FX and macro strategist for the Asia Pacific region, and I'm excited to have Joe Menimbo with us today. He's our FX and macro strategist for North America out of Washington, DC. Joe, thanks a lot for coming today.
Hey, thanks for having me. It's great to be along.
Excellent. Well, just before we start, I mean, it's been a pretty incredible year so far. We've seen, concerns about a potential recession. We've seen interest rates raised more than markets had expected, inflation relatively high, bank crises, and geopolitical tensions. And what's been remarkable is that US equity markets remain at 8-month highs, and volatility remains near 18-month lows. So for everything that's been thrown at financial markets, they've been remarkably resilient. So we're going to have a look at what's been driving markets at the moment and looking at some of the risks as we enter what is sometimes a more dangerous period in financial markets as we go into that Northern Hemisphere winter, or Northern Hemisphere summer. What we're looking at today is, first of all, our global economic outlook, what's been driving financial markets recently. We'll then look at some of the key currencies around the Asia Pacific region. We'll then throw to Joe and look at what's been driving the big US dollar markets. And then, as I said, that Q&A section at the end. And please, as I said, we've got that questions tab in the GoToWebinar controller. Please make sure you take advantage if you have any questions. Well, with that, I might turn off our cameras and we can focus on the slides. And what I certainly wanted to start off looking at was some of the key drivers that we've been seeing in financial markets and in FX markets in general. And last month in April, we saw the US dollar pressured with markets really preferring European currencies. It's been fascinating to see the euro US dollar move up towards 12-month highs. The US dollar fell to, the US dollar index fell to 12-month lows. The Australian dollar has fallen to close to 2-year lows versus the euro. So it's really been the case that the US dollar has fallen out of favour to an extent, and the European currencies have been a lot more favoured. In the euro US dollar pair moved up to that 110 level, that 12-month highs. Historically, key resistance hasn't been able to move significantly above that level. We have the European Central Bank on Thursday night, APAC time. That decision will be key to see whether the euro's gains can continue, not just versus the US dollar, but versus other currencies as well. The British pound has also been strong. The pound versus the US dollar up near 125. It's been a huge rally from the 105 levels that we saw back after that disastrous budget from Liz Truss back in September last year. Part of the reason why the pound's been so strong is that inflation remains very hot. In fact, in the UK, inflation's pretty much hotter than anywhere else in the developed market. And last month in April, we saw the March CPI number say that inflation's still in double digits at 10.1%. That's why markets are still looking for at least 3 more rate hikes from the UK. That's pulled back a little bit over the last week or so, but a terminal rate seen around about 5% on the British pound. And in Australia, the Australian dollar really fell into a lull. We've been really trading in quite a clear trading range between 65.50 to the downside and 68 to the top side, really for the last 2 or 3 months. And really, the Australian dollar has been weighed down by the fact that markets thought the Reserve Bank of Australia was on hold. But as we found out yesterday, that wasn't the case, with a surprise rate hike of 25 basis points, pushing the Aussie dollar higher. Still remains in that range. And I think the surprise that we've seen from the RBA this week, Joe is going to touch on about some of the surprise moves we got from the Bank of Japan last week, shows us that there are still plenty of capacity for unexpected events, driven in particular by central banks and central bank policy. So I'm just going to touch on the big 3 themes that we want to look at this month. And first of all, again, this explains why the Reserve Bank of Australia had to raise rates yesterday. Persistent core and services inflation. And there's been a lot of story about how headline inflation has come down so quickly. And that's the purple line. You can see here on that first tile, the purple line has come down pretty quickly from advanced economy inflation from around about 9% down to around about 6.5% since the middle of last year. That's been driven by goods inflation, and of course it was goods inflation that was initially driving inflation so much higher. Stuck at home during the pandemic, everyone was looking for a new monitor for their desk, a new exercise bike to keep the weight off, and a new Nintendo Switch for the kids. But there's only so many monitors, exercise bikes, and Nintendo Switches you can buy. So as people have pulled back on goods purchases, goods inflation has come back very quickly. That's pushed headline inflation lower as well, but look at those other 2 indicators. Core in salmon and services in teal, both still fairly much flatlining. And this is the problem for central banks, and this is why we might get more surprises, is that while headline inflation is coming down quickly, the more persistent inflation, core and services, so far hasn't budged. That's why the RBA needed to hike, despite saying last month that they were on a wait and see program. It's that persistence in some of those core inflation figures that are driving the central banks to potentially raise rates more than the market might currently think. Now, part of the reason why inflation has held up well, even while central banks have been raising rates, is because we've had surprisingly resilient data. We've seen the key economic releases over the last 3 or 4 months in 2023 so far, holding up relatively well. We've had patches where it's been disappointing, manufacturing in particular, but if we look at services, activity, if we look at global confidence numbers, they've held up much better than you would have expected after so many rate hikes. And here you can see in the Citigroup Global Index, inflation minus economic surprise index, economic data is still grading, economic surprises are still better than the inflation shocks that we are seeing. So again, data has held up remarkably well, and that's going to be the big question as we go into the Federal Reserve in particular, which is due tomorrow. Will the US Federal Reserve really be able to stop hiking rates if persistent core inflation remains high and if economic data still remains remarkably resilient? That also ties into that third tile there that we mentioned earlier, that in fact, FX has been remarkably quiet. Even while we've had this uncertain economic and monetary outlook, the improving data, particularly good earnings from US corporates, and the fact that markets tend to believe that central banks are near the end of their rate hiking cycles has kept inflation pretty low. We mentioned already that looking at some measures of inflation, we're at the lowest since early last year. So again, is this the fact that markets are just more confident about the future? Is this the calm before the storm? We just don't know. But the next few weeks, with major central bank decisions from the Fed, from the European Central Bank, and from the Bank of England, might go some way to telling us. Now, I'm going to pass on to Joe, and he's going to cover a couple of the big themes and events that are in focus over the next month. Joe.
All right, Steve, thank you so much. So on this slide here, this really highlights the divergent path for interest rates, and really interest rates, how they revolve around the world. That's one of the things that really sets currencies in motion. If you recall the US dollar last year, we saw the dollar rip to 20-year highs. And a lot of that had to do with the Fed's stance on monetary policy. We saw the Fed start aggressive. They raised rates 25, 50, 75 basis point clips. And all those rate hikes, that really attracted capital here to the U.S. But as we've seen, this story has really changed. It's gone from the Fed leading the charge in terms of 2022, raising interest rates, to a change in the theme, a change in the story this year, where the Fed is seen eventually taking more of a backseat role and allowing the other central banks like the European Central Bank that Steve mentioned, we're going to hear from this week, and the Bank of England. The Bank of England is going to be on deck next week, and they're going to be the ones to watch, because as you can see in this slide here, expectations for rate hikes and rate cuts, well, you can see the U.S. here, the U.S. is the more purple or lavender line. The market expectations have really zigzagged. They've been a bit all over the place. Markets have, when we took this snapshot, markets were baking in somewhere between 37 basis points in rate cuts by the end of this year. And if you weigh that against the outlook for other central banks, the ECB in teal, the Bank of England in black, you can see where those central banks are seen raising rates by at least 50 to 60 basis points or even more. And so that divergence in monetary policy, that has really tapped the brake on the dollar's the dollar's epic run from last year. And so, like I said, the dollar is now settled into a bit of a range, but it's losing ground to some of the higher yielding, or not so much the higher yielding peers, but central banks that are seen raising rates more than the Fed over the balance of the year. That has translated into meaningful strength we've seen for both the euro and for the British pound. Now, on the next slide, we're going to see here some of the key themes, or actually some of this is going to, when you get to your guide, your monthly guide for the month of May, you're going to see that it comes with this comprehensive calendar of market events. And what this goes to show is, what I want to show here is just a few items, and you can certainly take a look at some of the other ones at your leisure. But you can see that this week alone is really well represented when it comes to central banks. So we've got the Fed again and the ECB this week. The week after, we're going to hear from the Bank of England on the 11th of November, excuse me, on the 11th of May. And we're not going to hear from Canada this month. We're going to hear from Canada next in early June. But nonetheless, these central banks, as we heard from Australia this week, central banks have a penchant for surprise. And I just think that really goes to underscore how, as we emerge from the pandemic, a lot of these economic patterns have been really unpredictable, and it's caused central banks to really step up the fight against inflation, and that is keeping currencies on fairly choppy ground. So what we'll see on the next slide is going to be really the main event for this week. is the Fed going to raise rates as the market widely expects? But what does the Fed do after May? And that's going to be the key thing to look out for. And you can see how the odds of the Fed raising rates or holding them steady, they've really wavered, really going back to March into April when we saw the banking problems first erupt here in the US. That led markets to really scale back expectations for how much the Fed's going to be able to raise rates to fight inflation. But as you can see here, the line on the far right, that shows that the market is fairly confident that come tomorrow, the Fed, or actually it's today in APAC, the Fed is likely to raise rates by 25 basis points. But what's going to be really important, does the Fed give us a firm signal that it's going to pause? Now, that's something that Canada did earlier this year. The Bank of Canada raised rates in January, and they announced that they're going to hit the pause button. They're going to see how all their rate hikes over the past year are filtering in through the economy. But in the Fed's case, maybe the Fed could maintain a tightening bias or a bias to continue raising interest rates, because as Steve mentioned, core inflation is making a really slow decline back to the Fed's 2% target. So if core inflation continues to take, say, the scenic route back to 2%, well, maybe that suggests that the Fed, if it does pause rate increases, perhaps the next move might still be higher. And that's really different from what we're looking at in terms of the market, because like we saw in the previous slide, the market's baking in 1 to 2 or as many as a couple rate cuts from the Fed by the end of this year. So we'll get a little bit of clarity from the Fed tomorrow in terms of what their policy plans are. And that uncertainty, that is something that's really keeping currencies on their toes. And really, at least for the time being, that has kept the euro, while it's near one-year highs, it's kept the euro within the confines of its recent ranges against the greenback. On the next slide that we're going to see here, so here we go. Okay, Steve, I'll turn it back over to you now.
Yeah, no, thank you, Joe. That was great. And I think, like you say about market expectations for the Federal Reserve, that they'll hike at this meeting and then go on pause. Very similar to what the Reserve Bank of Australia did, but they needed to change that position very quickly within the month. And so central banks might think they're near the end of the inflation fight, but we'll have to wait to see how the data plays out. So they don't know for sure either. They're playing with only half the information also. So it just goes to show that this could continue to be a bit of a tricky year, both for central banks and for businesses with their foreign exchange exposure. So let's have a look at how the market or the month played out for the APAC region. And again, you can see that which currency pair across APAC had the highest levels of volatility over the last 30 days. Again, it was the Aussie yen. And of course, the Japanese yen has really been in focus ahead of the that first policy meeting from the new governor, Kazuo Ueda. That was last Friday, and he surprised markets by not tightening policy, but importantly saying that he wants a 1 to 1 year review of policy in Japan, and that means that we might not get any news about tightening, in the foreseeable future. So that drove quite a bit of volatility in the yen pairs, and drove a lot of volatility in the Aussie yen, which historically is one of the most volatile currency pairs in market. So again, really seeing a lot of the volatility in the Aussie yen and yen pairs in general. Then looking where the other volatility was over the month, the Kiwi, the New Zealand dollar, has seen a lot of volatility. You can see in 2, 3, and 4th position, the New Zealand dollar. Of course, the Reserve Bank of New Zealand surprised markets in the start of April by raising rates more than expected by 50 basis points from 4.75 to 4.25. And then at the end of the month, inflation, March quarter inflation actually came in lower than expected, pushing the Kiwi back lower. So you can see what's driving volatility in financial markets at the moment, particularly in FX markets, is that tension between the economic data and how central banks are reacting to that. So clearly the Kiwi driving that volatility. The Aussie US down the bottom of the range, well, in the middle to the bottom. And like we've said, the Aussie US really continuing to trade in this range. On the one hand, the expectation the RBA was on hold, kept the market depressed. On the other hand, better economic data from China in particular has provided some support. But for the moment, the Aussie US is trading in this very clear band, has been for over 2 months, 65.50 to the downside, 68 to the top side. And for businesses, your importers looking to take action near the top of the range, and your exporters looking to take action at the bottom of the range. Again, dollar Sing, the dollar, the Singapore dollar, and the US dollar, Chinese yuan at the bottom end of the range in terms of volatility. Where is the markets, these key APAC markets compared to their recent moving averages? And we use this to have an understanding of value. A market that's well above its moving average is seen as relatively high compared to where it has been. A market that's substantially below its moving average is seen as lower compared to its recent moving average. So it's a sort of dynamic measure of value. And to the top side, the US dollar, Chinese yuan, right at the top of the range around that 690 level. Again, while Chinese data has been better, it has been some areas of concern in the Chinese data, notably around the production numbers, the demand for manufactured goods from China. This ties into what we were talking about at the start, where we were talking about the goods inflation slowing. The developed world has reduced its demand for goods, and that's certainly impacted the Chinese economy as well. So the Chinese yuan certainly a bit weaker, and expectations that the People's Bank of China might need to loosen policy, cut interest rates, has also been weighing on the Chinese yuan. So certainly at the moment, anything above 690 has historically been seen as good buying for RMB buyers, for Chinese yuan buyers, and you can see that evidenced here using this value indicator. Also looking better, the Aussie Kiwi up near that 108, 109 level. Again, talking about ranges, the Aussie Kiwi has traded in a range between around 102 and 112 for the last 8 years. One of the most long-lasting trading ranges in FX markets. And as we get up towards that 110 level, you can see the Aussie Kiwi starting to show some signs of value up there. Otherwise, looking at the downside, where we're seeing value more on the export side of the equation, the Aussie US, obviously, down around that 67 level, the long-term average for the Aussie dollar around 72. The Aussie Kiwi down near that sort of 61 level. And then the Aussie Euro, which we already mentioned, near 2-year lows. And talking about long-term trading ranges, the Aussie Euro has tended to trade between around 60 to 65 over the last 10 years or so. And at the lower end of the range, you can see that value for exporters flashing there right throughout the Aussie Euro. All right, well, that was then. This is now having a look at our forecast and our future scenarios for the APAC region. And the Aussie US, you can see, downgraded somewhat over the last 12 months, last month, in terms of our forecast, down from around about a 68 to the end of the year, down to 67. Not huge, but still a move down lower. Again, partly because the RBA, even if they did hike rates this week, are still seen as having a relatively lower terminal rate where rates will end compared to where we thought maybe at the start of this year. So that's weighing on the Aussie dollar and just causing that baseline forecast just to be lowered. Again, I mean, it's important to remember the Aussie dollar is a volatile currency pair. Since it floated in 1983, it's moved on average 19% per year. So these kind of scenarios to the downside and the upside are extremely possible in a 12-month period. So what can drive the Aussie dollar to the downside of the market? Well, Joe was talking about it earlier. The Fed inflation fight, if it continues, is certainly the biggest risk for the Aussie dollar. Australian rates at 3.85 after yesterday's rate hike. US rates probably moving up to 5.25 after tonight. If we do see a rate hike, that's likely to see that interest rate differential continue to weigh on the Australian dollar, and that might be even greater if the Federal Reserve does look to tighten more than currently expected. So clearly that's the big risk. Of course, if we see higher US interest rates, that can hit equity markets. That often weighs on the Aussie dollar. It can see a slowdown in global growth. That also weighs on the Aussie dollar. So the worst case scenario for the Aussie dollar is if the Fed needs to continue that inflation fight. To the top side, what can really support the Aussie dollar? Well, if we start to see some more positivity from China, and in particular, if we start to see some more activity in those goods, in that industrial production, and in that construction space. So like most economies, China's seen an improvement in growth, but it's been driven by services. People are going out to restaurants again, to movies, having holidays, doing education, but they're not buying those traditional manufactured goods. So if we start to see an improvement in that, a bounce back in that, and that's certainly what can help the Aussie dollar. And certainly as well, as we mentioned, the financial markets are looking for rate cuts from the Federal Reserve at the end of this year. If we see those, if the Fed does cut rates, well, that will boost the Aussie dollar as well. So as you can see, the base case for the Aussie dollar for the rest of the year, to the downside 65, to the top side 70, and those extremities you can see for the rest of the year. 62 to the downside if we see further rate hikes, 74 to the top side if the Chinese recovery boosts the Aussie. Let's have a look at some of the other currencies around the region. The New Zealand dollar versus the US dollar, of course, is a similar currency to the Australian dollar. It's a commodity currency. It's driven by interest rate differentials, and the growth in China is important, more from the agricultural rather than the industrial space. But as I said, those views do remain broadly the same. And you can see here at the moment, again, an expectation of a drift lower for most of this year, with a year-end baseline target at 61 and the range of 58 to 64. Like I said, what can really drive the Kiwi into this kind of range to the downside? We already mentioned that if the Fed needs to keep hiking rates, but from the Reserve Bank of New Zealand, they've had a remarkable rush to raise rates from 0.25 to 5.25 in over 18 months. It's had a big impact on the New Zealand housing market. It's had a big impact on local consumer confidence. They did go big last month with a 50 basis point hike in early April. If the RBNZ does need to reverse that hike, then the Kiwi can be lower. To the top side, again, similar to what we said on the Aussie dollar, the Fed pauses, boost hopes globally, then the NZD, the New Zealand dollar, might look to gain. Okay, moving away from the Australia, New Zealand axis and into Asia, the dollar CNY. You can see the base case again broadly for the market to drift a little bit lower from where we are at the moment, down to around 690, not that far from where we are now. But certainly some of the views of an expectation of a dollar CNY that was much lower has started to fade away in general from the market. As we say, the Chinese recovery hasn't been as impressive as perhaps markets hoped back in December, January, when we saw that massive rally in financial markets throughout Asia. As I said, with that growth being less impressive in China, there's a concern that the People's Bank of China, the PBOC, might need to cut rates further to stimulate the economy. So broadly, you can see that the dollar CNY continues to provide opportunity for RMB buyers above 690, and I think that's really what we'll be focused on for most of this year. The last couple of days, we've seen again that levels just below 7 on the dollar CNY have continued to provide resistance, and it might be difficult for this market to move substantially above that without some kind of unexpected event. Historically, that 720 level has been very strong cap in price for most of the last 15 years. Again, what could drive the dollar CNY higher? Well, the US dollar story is going to be part of that. If we go higher, it'll be because of a big rebound in the US dollar. Joe talked about how we're still finding support on the US dollar around those 12-month lows. If the Fed does continue to tighten rates then further, then the US dollar might push higher. And again, if we do see Chinese growth pick up, that's going to be the big driver that pushes the dollar CNY lower as well. So again, very finely tuned, finely positioned on the dollar CNY. It's going to come down to Fed policy, and it's going to come down to People's Bank of China's policy and how that impacts on the Chinese growth story. And finally, looking throughout APAC on the Singapore dollar, and again, this is a pair that's been in quite a tight range. We've been seeing this not just in foreign exchange markets, but right throughout markets. And after the huge rally we saw in October through to around January, the last 3 months has really seen markets trading in a tight range. In the US dollar Sing dollar pair, it's been between around 132 and 134, and you can see that's the base case for most of this year, at our year-end baseline target at 134. To the top side, you can see that over the next sort of 3 to 6 months that there's a little bit more volatility in the price, and that's going to come down to the fact that we're waiting to see where the Federal Reserve settles. We're waiting to see how China recovers, but quite a broad range between 130 and 138 as we look over the next 3 to 6 months. And then beyond that, you can see an eventual move down lower as we sort of look further out, as the Singapore dollar likely to remain supported as global economy improves. So certainly over the longer term, the Singapore dollar is seen as strengthening. Again, the baseline is an expectation that growth will slow as those interest rate hikes around the world impact on Singapore in particular. That's what will keep it at the top end of the range, around that 134 level. Singapore very closely exposed to global growth, but also very closely exposed to goods activity, because there's a global trading hub as a key port for the region. If we're seeing less activity in goods, if we're seeing shipping prices or shipping costs, I should say, falling, that tends to weigh on the Singapore economy. So the next sort of 3 to 6 months, the outlook isn't great for the Singapore dollar, but over the longer term, it does turn more positive. Okay, a lot of what we've been talking about here is really will pivot on what happens over the next 24 hours, the next few weeks out of the US dollar. So I think this is probably a good point in the presentation to hand back to Joe, and he'll cover the US dollar and impact throughout North America over the medium term. Joe.
Steve, thanks so much. Boy, China really matters immensely for the global outlook. Great information there, so thank you so much. Yeah, so I want to talk about some of the currency pairs that are particular to the U.S. Region or North America region. And what I want to do, I want to show some volatility as well, some volatility analysis. And we're going to see how volatility has been sort of a mixed bag, if you will, for the U.S. dollar. On the one hand, we're seeing the dollar continue to struggle against the Mexican peso. Through the first 4 months of the year, dollar Mexico has spanned a vast 9% range. You can see there from inside of 18 to the dollar to above 19 per dollar. So once again, we're seeing that the peso ranks at the top of the performance table. And that largely has to do with central bank driven factors. Mexico has really been on a tear in terms of raising interest rates. Mexico has raised rates, I believe it's by 725 basis points since they started raising rates in mid-2021. And that's even outpaced what we've seen from the likes of the Fed. And that explains a lot of the outperformance we've seen for the peso. And like I said, it's been a bit of a mixed bag, if you will, in terms of volatility for the US dollar, because on the other hand, if you look at row 2, you can see where dollar yen exhibits remarkable strength. And that's also central bank rooted, because the Bank of Japan, they've had this hesitancy to join the wave of global interest rate hikes. And that has really put the yen at a disadvantage against peers, say from the US, from Canada, from Europe, that continue to push interest rates higher. And whereas Japan, they've maintained these rock bottom interest rates. And even though we have a new Bank of Japan governor in Ueda, we've got the same low rate policies, and it's unclear. We haven't seen any imminent sign that policy is going to change. But I think a lot of that has to do with the cloudy outlook for monetary policy in Japan. There's some risk out there that perhaps by the second half of the year, we could start to see some murmurs from Japan that they're starting to signal or starting to move in a more normalized direction in terms of interest rates. So once Japan does change course, that could be a potential launching pad higher for the Japanese currency. So that's one, again, you just want to warn about not getting complacent on yen weakness, and we'll have to see what the Bank of Japan has in store over the coming months. Now, in more of the middle of the pack in terms of volatility, that's where you find the US dollar versus Canada. Dollar Canada, for example, we've really kept to the middle of the pack, if you will, just the middle or the neutral ground of the range. You can see that the year-to-date position within the range, we're at nearly 50%. And a lot of that has to do with the similar path for monetary policy, both in Canada and in the US. Canada, like I said, they've already hit the pause button in terms of raising interest rates. They have maintained that the bar for cutting rates is pretty high. And maybe the Fed is right behind them. Maybe the Fed is next in line to hit the pause button. Like I said earlier, we may not get a firm steer from the Fed that they're going to indeed pause, but maybe we could see some signs from the Fed statement that ongoing interest rate hikes are no longer in the Fed statement. So we'll have to see. That has kept dollar Canada really confined to a fairly limited range. Euro dollar, on the other hand, you can see where euro dollar really retains the lion's share of its gains against its US counterpart this year. And again, that's on expectations. It looks like the ECB has to keep those hiking boots on longer than the Fed, and that has translated into really durable gains for the euro. But we'll have to keep our eyes on that Eurozone economy, because we've seen over the past couple weeks, we've seen some of the data has been mixed to even weak. Excuse me, some of the data has been mixed to even weaker, and maybe that's a sign that the economy over there in Europe remains in a fairly low gear. So if that's the case, maybe that could limit how much upward mobility there is to interest rates over there in the Eurozone. So data over the coming months, that's going to be a key thing to look out for. Over a 2 to 5 year horizon, however, we can see that we're going to see in the next one in the value indicator how the US dollar does retain some key strength. For example, the euro is certainly outperforming over the year to date and really over the past year, considering the euro's average rate over the past year, 104, a little bit above 104, and now we're in the 110s for euro dollar. But again, if you look a little bit longer term, over a 2-year span, it's little change, but if you go back 5 years, when the euro was above 112, you can see that the US dollar still retains a fair amount of strength against its Eurozone counterpart. Other currencies here, we can see some real marked appreciation in the dollar. Once again, here's a familiar pair, dollar yen. This year to date, it's not a large swing, but if you look at least 2 years out, you're looking at 7.5% of the average rates that we're actually now outperforming against. Whereas 5 years ago, if you compare the rate to where we were at the time, like 115 per dollar, that's a 16.5% appreciation that we've seen in the dollar against its Japanese counterpart. So those are just a few pairs there that you can see that we've seen some really explosive volatility, and a lot of that is rooted in central bank policy as traders continue to chase where interest rates are likely to be headed higher and seek that higher return. So that has been a key driving source of currency volatility over there. Now on the next slide, what I want to get into are some of the currency pairs. The pound is a really interesting currency pair if you consider that the Bank of England was one of the first, I think the first among the big central banks to raise interest rates, and they might actually be one of the last to stop raising interest rates, and that has a lot to do with the inflation picture over there in the UK that Stephen talked about. Inflation, it's spent 6 or 7 months above 10%, and that just goes to show that even though the Bank of England got a jump start on raising interest rates, say ahead of the Fed and the ECB, they're still struggling in this fight to bring down inflation back down to their 2% goal. So the pounds, we can see that the pound started the year at 120. It's climbed all the way up to June 2022 peaks of 125. And for the bull case for the pounds, a potential rise towards 130, well, that would be if the UK economy can maintain some of the recent resilience in the face of high inflation. That's going to be a key thing to look out for. UK interest rates right now, they're at 14-year highs of 4.25%. And right now the market's penciling in the peak rates somewhere around 5%. So it looks like there's more to go, more upside to go for UK interest rates. And if that central scenario plays out, that is one that could certainly be pound positive. Now, in terms of the bear case for the pound, could we see the pound revisit 120 against the US dollar? Well, that scenario could come into play if we see the UK economy start to lose momentum, if we see some of that resilience start to fade. That could be something that could push the pound lower. And if the Bank of England, what if they have to halt interest rate hikes sooner rather than later, and couple that with Fed rate cuts potentially not materializing by the end of the year? Again, those could be some scenarios that could push the pound lower. And on the next slide, I'm going to talk about Euro USD. Euro USD, the Euro USD started this year around 107. It marched all the way up to nearly 111 in mid-April. That was the highest level in a year. And the bull case for the euro, the upside scenario, could we see 111 or maybe higher? Well, that could be a scenario that comes into play if we see the ECB continue to go big in terms of interest rate hikes. We talked about the ECB on Thursday. It's considered a bit of a coin toss whether or not we're going to get a 25 basis point rate hike from the ECB or another 50 basis point rate hike. The ECB has raised 6 times in the current cycle, and they've done so by at least 50 basis points each time. So if we get another 50 basis point rate hike this week, that would tend to be euro positive because, like I said, some of the data has been mixed, and I think that's maybe making the case for the ECB to slow the pace of rate hikes. But one of the driving forces behind that tighter policy has been inflation, and we did see that inflation did inch higher for the month of April. It went from just below 7% to 7% once again. So 7%, that is a long way away from the ECB's 2% goal, and that could be a potential catalyst for the ECB to stay on this this path of raising interest rates larger than the average rate hike, which before the pandemic, it was the quarter-point rate hikes. Now, on the other side of the equation, in terms of the potential bear case or the downside scenario for the euro, could we see the euro fall back towards 108? What kind of factors might bring that into play? Well, if Europe's economy starts to lose steam and if inflation and higher rates start to take a toll on growth, and if the Fed maintains a high bar for cutting interest rates this year, those could be factors that push the euro down towards 108 against its U.S. counterpart. So maybe we'll get some insight this week from both the Fed and the ECB. That's why these meetings are going to be so critical for euro dollar and a lot of the dollar crosses going forward. And lastly, I've got one more currency pair to cover here, dollar Canada. Dollar Canada kicked off 2023 at 135, and we've strayed 3 cents to the top up to 138 to 3 cents to the bottom, 132 so far this year. And the central scenario calls for dollar Canada really to stay pretty much within the well-worn ranges that we've seen of late. Perhaps 136, 135 to 137 this year by the end of the year. But on the other hand, if there's an upside scenario for dollar Canada, if we could see the US dollar climb towards 140, well, that could be a scenario where we see Canada's economy start to falter. And if higher rates start to spur a bigger than expected retreat in both consumer and business spending, maybe that would lead the Bank of Canada to pull forward the time frame for potential rate cuts. And that would tend to be negative for the Canadian dollar. While at the same time, if the Fed refrains from loosening monetary policy, perhaps that can provide some support to the US dollar. So those are some upside factors for the US dollar versus Canada. Now, what could cause the US dollar to fall towards 130 versus Canada? Well, if Canada's economy starts to prove more resilient than anticipated, keep in mind, like a lot of these major economies, Canada is home to a really tight labor market. Unemployment in Canada is holding around 5%. That's a historically low level. We're going to get a new update on Canadian jobs on Friday of this week, so that's going to be a key focal point. But if Ottawa maintains a high bar for cutting interest rates, that would certainly be positive for Canada. While if the Fed has to really almost succumb to market expectations and cut interest rates by the end of this year, that would tend to weigh on the US dollar and give a boost to the dollar's counterparts, such as the Canadian dollar. And now we want to open up the floor to any questions. If anybody has any questions, we'll be happy to entertain those.
Thanks, Joe. That was really fantastic, and I know a lot of our customer base throughout Asia is particularly interested in the yen and the euros. So really appreciate your insights and update on that. Look, just a reminder to everyone to please use the questions tab in the Go to Webinar controller that you have there. We've got a couple of questions already, but we'd like to make sure that anyone that wants the opportunity has that opportunity. We've got a bit of a curly one to start off with, Joe, and I might hand that to you. You're our man in Washington, D.C., so you're perfectly placed. But this question's about the debt ceiling. It's getting a lot of coverage here at the moment. Wanted to get your views on what it will mean, or how you think it might end up playing out, which I know is a really tricky part of it, but what might be the impact on the US dollar?
Good question. Boy, what a thorny subject, whether you're talking currencies or what have you. But historically, the debt situation, that's been a bit of a double-edged sword, if you will, for the dollar, because on the one hand, you tend to see the dollar benefit as a safe haven anytime you see worries about a potential U.S. Catastrophic debt default. But that wasn't always the case. What was the last time in 2011? We did see the dollar lose some ground in the run up to that. So it's highly uncertain. Hopefully, we'll get at least an 11th hour deal that avoids a debt default. But again, this situation creeps up from time to time, and I think that this just goes to show that it's a highly uncertain situation, and if it just depends on the degree of market concern. If we have full-blown panic out there, if it's a really messy financial situation globally, well, that would tend to be a situation where the dollar benefits as a safe haven. If it's more, I don't know if you can really say this, but garden variety concern, that's where we could see other safe havens, the Swiss franc, the Japanese yen, really benefit. Because at the end of the day, if we have another fire to put out, if there's another thing to worry about in terms of the U.S. economy, we've got banking woes, we've got the Fed still raising interest rates. If there's another thing for the market to grapple with, I think that would only increase the downside risk to the economy, and that could increase the risk of recession. And if we're talking U.S. underperformance, a weak U.S. economy, then yeah, that could be a situation where indeed the Fed may need to cut rates, which is certainly a dollar negative topic right now.
Great. Thank you very much for that. I'll look another question, just wanting to look a little bit beyond the very short term, and we've mentioned that there's three big central bank decisions, the Federal Reserve, the ECB, and then next week, the Bank of England. But Joe, beyond those central bank decisions, what do you think is going to be in focus in markets as we get towards the end of May?
Yeah, as important as this month's central bank meetings are, I think you could make the case that next month's are going to be more important. And I say that because we're going to get some new forecasts from both the Fed and from the ECB. So does the Fed still maintain that the U.S. economy is likely to avoid recession, or do they maintain that they have no intention to raise interest rates at this point? That's going to be a key thing to look out for. And from the ECB, we'll get some guidance there. That's going to be a key thing to look out for. And like I said, we didn't hear from Canada. We're not going to hear from Canada for the month of May. We last heard from Canada in mid-April. So their next meeting is, I think it's the 7th of June, early June nonetheless. And that's going to be a key event to watch as well. I think we're getting some new forecasts from Canada. So again, there's a lot of uncertainty with respect to the outlook for monetary policy globally. And each month we get a little bit more clarity, and that'll help drive the story going forward.
Yeah, thanks, Joe. It certainly sounds like it's going to be a period where we do get that sort of developing information and that sort of uncertain potential for risks from left field, even that debt ceiling as well. So, look, we might leave it here now, but we'll be able to cover, of course, all those issues in the next of our monthly webinars. That'll be in the first week of June. Don't forget as well that what we produce in these webinars are based on the Global FX Outlook, which is a document that really we've produced that sort of supersedes the monthly currency outlook. It has all of those details, but the forecast, it has the appendix with a whole series of forecasts for different pairs as well. So please reach out to your account manager if you want that detail. That'll be released over the next day or so after the webinar. And of course, this webinar will be, it's been recorded and will be sent to everyone that attended via email. But look, just want to thank everyone for attending, and really want to thank Joe as well for staying up remarkably late to help us produce this webinar. It's great to get the insight from you, not just your knowledge, but being on the ground there Really fascinating to get that insight as well. So thanks again, Joe. We really appreciate everyone here in the APAC region. And with that, we'll call it quits. Thanks thanks very much for everyone for coming along. We really appreciate you coming to these webinars. And of course, if you need anything from us, just please reach out. Thank you very much. Bye-bye.
Thanks, everybody.